Hello everyone, welcome to the weekly lecture videos once again. And this is the last video for chapter 2. And in this video, I'm going to discuss the fourth learning objective, determine a firm's cash flow from its financial statements. At this point, we are ready to discuss one of the most important pieces of financial information, which is cash flow. By cash flow, we mean the difference between the number of dollars that come in and the number that went out. For example, if you were the owner of a business, you might be very interested in how much cash you actually took out of your business in a given year. Okay. There is no standard financial statement that presents this information in the way that we would like. We will therefore discuss how to calculate cash flow for a typical Australian company and point out how the result differs from the standard financial statement calculations. There is a standard financial accounting statement called Statement of Cash Flows, but it is concerned with a somewhat different issue that should not be confused with what we learned here. From the statement of financial position identity, we know that the value of a firm's asset is equal to the value of its liabilities plus the value of its equity. Okay. Similarly, the cash flow from the firm's assets minus the cash flow from firm assets must equal the sum of its cash flow to creditors and the cash flow to shareholders. Okay, so you can see here that the cash flow from the assets must be equal to cash flow to creditors and cash flow to shareholders. And this is called cash flow identity, which reflects the fact that a firm generates cash through its different activities. Okay. Now, cash flow to creditors and shareholders represent net payments to creditors and owners during the year. Okay. They are calculated in a similar way. Okay, so you can see that cash flow to creditors is interest paid minus net borrowing. Okay, and cash flow to shareholders is dividend paid minus net new equity raised. Okay. Now, if we continue discussing the cash flow from assets. So cash flow from assets essentially has three components. One is operating cash flow, another is net capital spending, and finally, change in net working capital. Okay, so operating cash flow refers to the cash flow that results from firms' day-to-day activities, for example, production and sales. Okay, expenses associated with firm's financing of its assets are not included in the operating cash flow. In a normal course of events, some portion of the firm's operating cash flow is reinvested in the firm. Okay, so capital spending in this case refers to the net spending on non-current assets. So, for example, purchase of non-current assets less sales of non-current assets. And change in net working capital finally is the amount spent on net working capital. It is measured as the change in net working capital over the period being examined and represents the net increase in current assets over current liabilities. So which means that net working capital is current assets minus current liabilities. And when we say change in net working capital, which should be the net working capital this year minus net working capital the previous year. Okay. To calculate operating cash flow, we want to calculate revenues minus costs, okay? But we do not want to include either depreciation since it is a non-cash outflow, okay? Or interest because it is a financing expenses. And we do want to include taxes because taxes are unfortunately paid in cash. So you can see that to calculate operating cash flow, what we do is earning before interest and taxes, we add back depreciation. Okay, because this depreciation was deducted and it didn't actually result in a cash outflow. So it is added and the taxes are deducted to find out operating cash flows. Net capital spending is just money spent on non-current asset, less money received from the sale of non-current assets. Okay, so non-current asset means fixed assets like land, building, machineries, equipments, and so on. Okay, so net capital spending essentially is the ending net fixed asset minus beginning net fixed asset plus depreciation. That is the net capital spending. And the last component in this cash flow from asset is the change in net working capital, as we have been discussing. In addition to investing in non-current asset, a firm also invests in current assets. Okay, current asset means, for example, invest in inventory, raw material, and so on. As the firm changes its investment in current asset, its current liabilities will usually change. And to determine the change in net working capital, the easiest approach is just to take the difference between the beginning and ending net working capital net working capital figures that I just mentioned a few moments back. So you can see that change in net working capital is ending minus beginning net working capital. Now let's learn another concept, which is free cash flow. Cash flow from assets sometimes go by a different name called free cash flow. Well, there is no such thing as free cash, right? Instead, the name refers to cash that the firm is free to distribute to creditors and shareholders because it is not needed for working capital or the non-current asset investment. Okay, we will stick with cash flow from asset as our label for this important concept because in practice this is the term that typically used, and there is some variation in exactly how free cash flow is computed as different users calculate it in different ways. Okay, in your textbook, you will find a good example that how cash flow is determined from financial statements. So I will suggest that everyone go through that example to get a good understanding. Okay, so cash flow can be calculated from other financial statement information. For example, first of all, it's a statement of profit and loss, and you can see that's a typical profit and loss statement. And from these, what we can do is, first of all, we can calculate operating cash flow. So operating cash flow essentially is EBIT minus plus depreciation. As we have seen a few moments back, the depreciation is added back, and then we deduct taxes. So that is operating cash flow. And net capital spending, as I already mentioned, that net capital spending is beginning non-current assets, which is this. Okay, this is beginning non-current asset. These numbers are available in the example in your textbook that I mentioned. So this is the ending non-current assets and minus beginning non-current asset plus depreciation. So that is net capital spending. Okay. And change in net working capital, I also mentioned that change in net working capital is ending minus beginning net working capital. And net working capital, as I mentioned, is the difference between current asset minus current liabilities. Okay, and cash flow from assets is the operating cash flow that we calculated here, and then minus net capital spending we calculated here, and minus change in net working capital that we calculated here. So that is cash flow from assets. Okay, just some additional calculation. You can see this is the beginning net working capital. So beginning current asset minus current liabilities, and sorry, this is the ending net working capital, current asset minus current liabilities, and beginning net working capital, which is the beginning current asset minus current liabilities. Okay, so cash flow to creditor is the interest paid minus net loan, and finally cash flow to shareholder is dividend minus net equity. Okay, so this is how we can estimate cash flows from the other financial statements of a company. Okay, so once again, go through this detailed example in the textbook to have a better understanding of this. Okay, so thank you very much for listening, and this is the end of our discussion of this learning objective. Okay, thank you very much.